I've studied every major housing market collapse in modern history. The Great Depression, the savings and loan crisis in the 1980s, the Japanese real estate bubble in the 1990s, the US housing crash in 2008, the European debt crisis. Every single one. And I've learned something that most people don't understand. Housing market collapses don't just happen randomly. They're not acts of God. They're not unpredictable black swan events. They follow a pattern, a very specific, very recognizable pattern. And when you know what to look for, you can see them coming from miles away. Today, I'm going to share that pattern with you. I'm going to show you the 5 things that always happen before a housing market collapses. Not sometimes, not usually, always. Every single housing crash in history has been preceded by these 5 warning signs. And I'm going to explain why each one matters, how they interact, and most importantly, whether we're seeing them today. Because if we are, you need to know. You need to prepare, you need to protect yourself before the collapse happens. Let me start with the most important warning sign. The one that appears in every housing crash without exception. Warning sign number 1 is excessive price appreciation disconnected from fundamentals. Housing prices are supposed to track fundamentals. Income growth, rent growth, population growth, construction costs. These are the underlying drivers of housing value. When median home prices rise roughly in line with median incomes, the market is healthy. When rents are rising because demand is strong, higher home prices make sense. When population is growing and we're not building enough homes, prices should increase. That's normal. That's sustainable. But when housing prices start rising much faster than fundamentals, when they decouple from income and rent growth, when the price to income ratio or the price to rent ratio starts climbing to levels never seen before, that's a red flag, a huge red flag, because it means prices are being driven by something other than fundamental demand. Usually, they're being driven by speculation and excess credit. Let me give you specific numbers so you understand what I mean. In a healthy housing market, the median home price is typically about 3 to 4 times median household income. So if the median household earns $70,000 per year, the median home price should be around $210,000 to $280,000. This ratio has been remarkably stable over long periods of time. It makes sense intuitively. People can afford to borrow about 3 to 4 times their annual income when mortgage rates are reasonable. Banks are willing to lend that much. It's sustainable. But in the lead up to the 2008 crash, this ratio went completely out of whack. By 2006, the median home price in many markets was 6 to 7 times median income. In some bubble markets like California and Florida, it was 8 to 10 times. This was unprecedented. There was no fundamental reason for it. Incomes hadn't doubled. Population growth hadn't accelerated. The only thing that had changed was credit availability. Banks were lending to anyone with a pulse. No documentation loans, no money down, adjustable rate mortgages with teaser rates. People who couldn't afford homes were buying them anyway because credit was free-flowing, and this drove prices to insane levels. When I saw the price-to-income ratios in 2006, I knew the market was going to crash. It was mathematically inevitable. You can't sustain home prices at 8 times income. People can't afford the payments. Eventually, buyers disappear. Demand collapses. Prices fall. And that's exactly what happened. From 2006 to 2012, home prices fell by 30 to 40% nationally. In bubble markets, they fell by 50 to 60%. The price-to-income ratio normalized back to 3 to 4 times. The market corrected. The same pattern appeared in Japan in the 1980s. Tokyo real estate prices went completely insane. Office buildings in Tokyo were selling for prices that implied cap rates of 1%. 1%. That means you'd need 100 years of rent to pay back your purchase price. Residential prices were even crazier. The Imperial Palace grounds in Tokyo were theoretically worth more than all the real estate in California. This was obviously absurd. And when the bubble popped in 1991, Japanese real estate fell by 70% and still hasn't fully recovered 30 years later. The lesson is clear. When housing prices disconnect from fundamentals, when the price-to-income ratio or price-to-rent ratio climbs to unprecedented levels, a collapse is coming. It's not a matter of if, it's a matter of when. So that's warning sign number 1. Excessive price appreciation disconnected from fundamentals always appears before a collapse. Warning sign number 2 is easy credit and declining lending standards. Housing markets are deeply connected to credit markets. Most people can't buy a home with cash. They need a mortgage. So the availability and cost of mortgage credit has a huge impact on housing demand and prices. When mortgage rates are low and lending standards are loose, more people can afford to buy homes. Demand increases. Prices rise. When rates are high and lending standards are tight, fewer people can afford to buy. Demand decreases. Prices fall. This is normal. But in the lead up to a housing bubble, something dangerous happens. Lending standards don't just loosen a little. They collapse completely. Banks start making loans to people who have no ability to repay. They start offering products that are designed to fail. And they do this because they're not holding the loans. They're selling them to Wall Street, which packages them into securities and sells them to investors. The banks get their fees up front and pass the risk to someone else. This creates horrific incentives. In the early 2000s, we saw lending standards deteriorate to levels that were criminally negligent. Ninja loans, no income, no job, no assets. You could get a mortgage without proving you had any ability to repay. Stated income loans, nicknamed liar loans, where you just wrote down whatever income you wanted and the bank didn't verify it. No money down loans. You could buy a house with zero equity. If prices fell even a little, you were immediately underwater. Adjustable rate mortgages with teaser rates. Pay 2% for the first 2 years, then the rate jumps to 7 or 8% and your payment doubles. People who could barely afford the teaser rate had no chance of affording the reset. Option arms. You could choose to pay less than the interest due, and the unpaid interest would be added to your principal. Your mortgage balance would actually grow over time. Insanity. These products were designed to get people into homes they couldn't afford, and they worked. Homeownership rates climbed to all-time highs. Demand was artificially inflated. Prices soared, but it was all built on a foundation of bad debt. When those teaser rates reset, when people couldn't make the higher payments, when they started defaulting, the whole house of cards collapsed. Foreclosures spiked. Supply flooded the market. Prices crashed. The same pattern appeared in the savings and loan crisis of the 1980s. S and Ls were making crazy loans to real estate developers. Office buildings that had no tenants, condos that had no buyers. The loans were bad from day one, but S and Ls kept making them because they were gambling with depositor money and government insurance. When the projects failed and the loans defaulted, hundreds of S and Ls went bankrupt. The government had to bail out the industry, and commercial real estate prices crashed. So warning sign number 2 is easy credit and declining lending standards. When you see banks making loans to people who can't possibly repay, when you see exotic mortgage products designed to circumvent affordability constraints, when you see underwriting standards disappear, a collapse is coming, because all those bad loans will default. And when they do, the foreclosures will flood the market with supply and crash prices. Warning sign number 3 is rampant speculation and investor activity. In a healthy housing market, most buyers are owner-occupants. People buying homes to live in. They're making long-term decisions based on their housing needs and their ability to afford the mortgage payments. They're not trying to flip the house for a quick profit. But in a bubble, speculators take over. Investors who have no intention of living in the properties they're buying to flip, buy a house, hold it for 6 months or a year, sell it for a quick profit, or they're buying to rent, hoping that rent growth and price appreciation will give them good returns. When speculation becomes rampant, it's a sign that the market has disconnected from housing fundamentals and become a vehicle for financial speculation. This is dangerous for several reasons. First, speculators are momentum buyers. They buy because prices are going up. They have no underlying need for housing. When prices stop going up or start falling, they disappear instantly. They're not going to hold a depreciating asset. They sell immediately. This creates a self-reinforcing crash. Prices start falling. Speculators panic and sell. Supply floods the market. Prices fall more speculators sell. It cascades. Second, speculators often use maximum leverage. They put down the minimum down payment and borrow the rest. When prices fall and they're underwater, they have no emotional attachment to the property. They're not living in it. They just walk away. Strategic default. This adds to foreclosures and supply. Third, when speculators dominate the market, it's a sign that normal buyers have been priced out. Regular people who want to buy a home to live in can't afford current prices. The only buyers left are speculators betting on further price increases. When the speculators stop buying, there's no one left. Demand evaporates. In the lead up to the 2008 crash, speculation was rampant. In markets like Las Vegas, Phoenix, and Miami, investor purchases were 40 to 50% of all transactions. People were buying multiple properties with no money down, planning to flip them. TV shows glorified house flipping. Everyone thought they could get rich in real estate. When prices peaked and started falling, all those speculators tried to sell at once. But there were no buyers. Inventory exploded. Prices cratered. The same thing happened in Japan. In the late 1980s, Japanese companies and individuals were buying real estate purely for speculation. They believed land prices would rise forever. It was a national obsession. When the bubble popped, all those speculative holdings were sold. The market was overwhelmed with supply. Prices collapsed and took decades to recover. So warning sign number 3 is rampant speculation and investor activity. When investors represent a large percentage of buyers, when everyone is talking about getting rich in real estate, when housing has become a speculative asset rather than a place to live, a collapse is near. Warning sign number 4 is overbuilding and excess supply. Housing supply responds to demand with a lag. It takes time to buy land, get permits, and build homes. Typically, the development cycle is 2 to 3 years from when a project is conceived to when homes are completed and ready for sale. This lag creates a dangerous dynamic in bubbles. When prices are rising and demand appears strong, developers rush to build. They start projects based on current market conditions. But by the time those projects are completed 2 or 3 years later, market conditions have changed. Demand has weakened, prices have peaked or started falling, and suddenly there's a glut of supply hitting the market at exactly the wrong time. This excess supply exacerbates the crash. Not only is demand falling because speculators are gone and credit is tightening, but supply is surging because of all the projects started during the boom. Basic economics tells us what happens when supply increases and demand decreases simultaneously. Prices collapse. In the lead up to the 2008 crash, housing starts were running at an annual rate of over 2 million units. This was far above the long-term average of about 1.5 million units, which is roughly what's needed to keep up with population growth and household formation. Builders were constructing homes at a rate that far exceeded fundamental demand. They were building for speculators and investors, not for real housing needs. When the bubble popped, all those excess homes came on the market. But buyers had disappeared. Builders slashed prices, trying to move inventory. This put downward pressure on all home prices, including existing homes. Foreclosures added even more supply. At the peak of the crisis, months of supply, which measures how long it would take to sell all the homes on the market at the current sales pace, reached 12 to 15 months in some areas. A balanced market is around 6 months of supply. 15 months is a massive glut. Prices had to fall to clear the excess inventory. The same pattern appeared in the commercial real estate crash of the late 1980s. Developers built massive amounts of office space during the boom. When the economy slowed and demand for office space weakened, all those new buildings sat vacant. Rents fell. Property values crashed. So warning sign number 4 is overbuilding and excess supply. When housing starts are well above the long-term trend, when developers are building speculatively rather than based on real demand, when months of supply starts increasing, a crash is coming. The excess supply will overwhelm demand and force prices down. Warning sign number 5 is euphoria and widespread belief that prices can only go up. This is the psychological warning sign, and it's incredibly important. Markets are driven by psychology as much as by fundamentals. When everyone believes that housing prices will keep rising forever, that real estate is a can't-lose investment, that we've entered a new era where old rules don't apply, you're at the peak of a bubble. This euphoria manifests in several ways. Media coverage becomes relentlessly positive. Every news outlet is running stories about how to get rich in real estate. TV shows about house flipping proliferate. Real estate agents become celebrities. Ordinary people start talking about real estate at parties and dinners. Your Uber driver tells you about the 3 investment properties he owns. Your hairstylist is flipping condos. Everyone has a story about how much money they made on their house. The fear of missing out becomes overwhelming. People who were cautious start thinking they're being foolish. Everyone else is getting rich. Why aren't they? They need to get in before prices go even higher. Skeptics are dismissed as fools who don't understand the new paradigm. If you suggest that prices might be too high or that a correction is possible, people laugh at you. They say, real estate always goes up, or they're not making any more land, or it's different this time. These mantras become gospel. This euphoria is dangerous because it indicates that the market has been taken over by emotion rather than reason. People are not making rational economic decisions. They're buying because everyone else is buying. They're buying because they're afraid of missing out. They're buying because they think they'll get rich. When the euphoria reaches a peak, when absolutely everyone believes prices will keep rising, that's when the collapse begins. because there are no skeptics left to convert into buyers. Everyone who's going to buy has already bought. There's no new demand to push prices higher, and without new demand, prices stall. Once prices stall, the psychology reverses. If prices aren't going up, why hold real estate? The speculators sell. This pushes prices down. Fear replaces greed. People who were desperate to buy at any price become desperate to sell at any price. The crash feeds on itself. I saw this in 2006. Everyone was convinced that real estate only went up. People were using their homes as ATMs, taking out home equity loans to fund consumption. They felt rich because their home values were rising. Anyone who suggested caution was dismissed. But I looked at the fundamentals. Price to income ratios were at record highs. Lending standards had collapsed. Speculation was rampant. Supply was surging. And everyone was euphoric. All 5 warning signs were present. I knew a crash was coming. And in 2007, it began. Prices started falling. By 2008, it was a full-blown crisis. By 2012, prices were down 30 to 40% nationally. So warning sign number 5 is euphoria and widespread belief that prices can only go up. When everyone is bullish, when skepticism is non-existent, when real estate dominates conversations and media coverage, when people believe old rules don't apply, the peak is near. Now, let me talk about how these 5 warning signs interact and reinforce each other, because they don't happen in isolation. They feed off each other in a vicious cycle that creates the bubble and then causes the crash. It starts with easy credit. When lending standards loosen and mortgage rates are low, more people can afford to buy. Demand increases. Prices start rising. Rising prices attract speculators. They see an opportunity to make money. They start buying investment properties. This adds to demand. Prices rise faster. Faster price appreciation validates the speculation. People who bought are making money. This attracts more speculators. Media coverage becomes positive. Everyone starts talking about real estate. Euphoria builds. The euphoria feeds back into lending. Banks see that real estate prices are rising. They believe real estate is a safe investment. They loosen standards further. They offer more exotic products to help people afford higher prices. This adds more demand. Prices rise even faster. Developers see the strong demand and rising prices. They start building aggressively. But the construction takes time. Meanwhile, prices keep rising. This validates their decision to build more. More projects are started. Eventually, fundamentals can't keep up. Prices have risen so far above income and rent levels that normal buyers are priced out. The only buyers left are speculators, but speculators are momentum buyers. When price appreciation slows, even a little, they get nervous. Some start to sell. This increases supply. Prices flatten or dip slightly. More speculators see this and sell. Supply increases more. Meanwhile, all the construction projects that were started during the boom are completing. New supply hits the market. At the same time, demand is falling as speculators exit and lending standards start to tighten. Supply is increasing. Demand is decreasing. Prices fall. Once prices are falling, the psychology reverses completely. Fear replaces greed. Everyone wants to sell. No one wants to buy. Foreclosures start as people who bought with easy credit can't make payments. This adds to supply. Prices fall more. It becomes a self-reinforcing crash. This is the pattern. Every bubble follows it. The 5 warning signs appear. They interact and amplify each other. The bubble grows, then it pops. And the crash is usually much faster and more severe than the rise. Bubbles inflate slowly over years. They deflate quickly over months. Now, the critical question, are we seeing these warning signs today? Is the housing market setting up for another collapse? Let me go through each warning sign and assess where we are. Warning sign 1, excessive price appreciation disconnected from fundamentals. This one is clearly present. Home prices have risen dramatically since 2020. The pandemic caused a surge in housing demand. People wanted more space. Remote work allowed people to move to cheaper areas. Interest rates were at record lows. All of this drove prices up by 30 to 40% nationally in just 2 to 3 years. The price-to-income ratio has climbed to levels approaching the 2006 bubble. In many markets, homes are 6 to 7 times median income. This is not sustainable. Incomes have not risen enough to justify current prices. Rents have risen, but not as much as home prices. The price-to-rent ratio is also elevated. So yes, we have significant price appreciation disconnected from fundamentals. Warning sign 1 is present. Warning sign 2, easy credit and declining lending standards. This is more nuanced. Lending standards today are much tighter than they were in 2006. We're not seeing ninja loans or stated income loans. Underwriting is more rigorous. Borrowers have to document income and assets. Down payments are typically required. Credit scores are checked. So in terms of lending standards, we're in much better shape than we were before the 2008 crash. However, credit has been very easy in a different way. Interest rates were near zero for years. This allowed people to borrow large amounts at very low rates. A buyer could afford a much more expensive house at 3% interest than at 7% interest. So even with tighter underwriting, the low rates fueled demand and pushed prices up. Now, rates have risen from 3% to 7% over the past 2 years. This has dramatically reduced affordability. The monthly payment on a median-priced home has nearly doubled because of higher rates. This is choking off demand. Sales volumes are down significantly, so we had easy credit in the form of low rates, which contributed to the price surge. Now credit is tightening in the form of higher rates. This is creating stress in the market. Warning sign 2 is partially present. Not as extreme as 2006, but still a factor. Warning sign 3, rampant speculation and investor activity. This was very present during the pandemic. Investor purchases surged to record levels. In some markets, investors were 30 to 40% of buyers. People were buying homes sight unseen, waiving inspections, bidding way over asking price. There was definitely speculative fervor. However, this has cooled significantly. As prices have leveled off and rates have risen, investor activity has declined. Speculators have pulled back. So this warning sign was present in 2021 and 2022, but has diminished in 2023 and 2024. Still, the damage may already be done. The speculation pushed prices to unsustainable levels. Now, those speculative buyers may be sitting on properties that are declining in value. Some may be forced to sell. This could add to supply and pressure prices. So warning sign 3 was present during the price surge and may still contribute to a downturn even though speculation has cooled. Warning sign 4, overbuilding and excess supply. This is where the current market differs significantly from 2006. We have not overbuilt. In fact, we've underbuilt for over a decade. From 2008 to 2020, housing construction was well below the long-term average. We were building about 1 million units per year when we needed 1.5 million to keep up with household formation. This created a shortage. Inventories of homes for sale are at historic lows. Months of supply is well below 6 months in most markets. There is not an excess supply problem. In fact, we have a supply shortage. This is a key difference from prior bubbles. Without excess supply, it's harder for prices to crash. If demand weakens, prices may flatten or decline modestly. But without a glut of inventory, a collapse is less likely. So warning sign 4 is not present. This is a significant mitigating factor. Warning sign 5, euphoria and widespread belief that prices can only go up. This was definitely present in 2021. Everyone was talking about real estate. Bidding wars were common. People were waiving contingencies and paying whatever it took to get a house. There was FOMO everywhere, but this has cooled as well. As prices have leveled off and affordability has worsened, the euphoria has faded. People are no longer convinced prices will keep rising. In fact, there's growing concern about a potential downturn. So the euphoria has passed. We may already be in the early stages of the psychology reversing. So where does this leave us? 3 of the 5 warning signs are present or were recently present. Excessive price appreciation, easy credit through low rates, and speculation. 2 of the 5 are not present or are mitigating factors. Lending standards are decent, and we don't have excess supply. This is a mixed picture. It suggests we're unlikely to see a crash as severe as 2008. The tight lending standards mean we won't have a wave of foreclosures. The lack of excess supply means prices have some support. But we could still see a significant correction. Prices rose too far, too fast. Affordability is terrible. Demand is falling as rates have risen. Prices are starting to decline in many markets. I expect we'll see prices fall by 10 to 20% nationally over the next couple of years. Some bubble markets could see declines of 25 to 30%. This is not a collapse like 2008, but it's a meaningful correction that will cause pain for recent buyers and for the economy. Let me be specific about what I think will happen. Higher mortgage rates will keep demand suppressed. At 7% rates, far fewer people can afford to buy. Sales volumes will remain low. Without demand, sellers will have to reduce prices to attract buyers. Prices will grind lower over months and years. Some recent buyers who stretch to afford homes will find themselves underwater. They owe more than the home is worth. If they need to sell, they'll take a loss. Some will be forced to sell due to job loss or financial stress. This will add to supply and pressure prices. Builders will slow construction as demand weakens. But because we have a supply shortage, they won't stop entirely. They'll just build at a more moderate pace. The economy will feel the impact. Falling home prices create a negative wealth effect. Homeowners feel poorer. They cut spending. This slows economic growth. Construction activity slows, which costs jobs. Mortgage lending slows, which hurts financial sector employment. We could see a mild recession as a result. But again, this is not 2008. The banking system is much better capitalized. Lending standards are tighter. We don't have toxic mortgage securities threatening the financial system. This will be a garden variety housing correction and mild recession. Painful, but manageable. Now, what should you do with this information? If you're thinking of buying a home to live in and you can afford the payments comfortably, it's probably fine to buy. You're buying for housing, not as an investment. You'll live there for years. A 10 or 20% price decline over the next couple of years doesn't matter much if you're staying for a decade. But don't stretch to buy. Don't assume prices will keep rising. Don't count on appreciation. Buy what you can comfortably afford at current rates. If you're buying as an investment or to flip, be very careful. The speculative profits are gone. Prices are more likely to fall than rise over the next few years. You could lose money. I'd avoid speculative real estate purchases. If you own a home and you're thinking of selling, consider your timeline. If you don't need to sell in the next couple years, you can wait out the correction. Prices will eventually recover. But if you need to sell soon, you may have to accept a lower price than you would have gotten in 2021. If you're a builder or developer, be cautious about new projects. Demand is weakening. It's not a good time to start speculative developments. Build only what you have pre-sold or what you're confident you can sell at current prices. And if you're an investor in mortgage securities or financial institutions with real estate exposure, monitor the risks carefully. This is not 2008, but there will be losses. Make sure you understand your exposure. The key takeaway is this: housing market collapses follow predictable patterns. The 5 warning signs I've outlined always appear before a crash. Excessive price appreciation disconnected from fundamentals, easy credit and declining lending standards, rampant speculation, overbuilding and excess supply, euphoria and belief that prices only go up. When you see these signs, a correction or crash is coming. The severity depends on how many signs are present and how extreme they are. Right now, we have a mixed picture. Some warning signs are present, some are not. This suggests a correction, not a collapse. Prices will likely fall 10 to 20%, but it won't be catastrophic like 2008. Still, you should be prepared, understand the risks, make decisions accordingly. Don't assume prices will keep rising. Don't stretch to buy. Don't speculate. Be prudent, because even a modest correction can be painful if you're on the wrong side of it. And remember, these cycles repeat. We'll see another housing bubble someday. The warning signs will appear again. Human nature doesn't change. Greed and fear drive markets. When you see the warning signs, act accordingly. That's the lesson. That's what I've learned from studying every housing crash in history. And that's what I'm sharing with you today, so you can protect yourself and make better decisions. The warning signs are there for those who know how to read them. Pay attention, be smart, and you'll navigate these cycles successfully. Now let me go much deeper into each of these warning signs with specific historical examples and data so you can truly understand the mechanics of how housing markets collapse. Let's start with warning sign 1, excessive price appreciation disconnected from fundamentals, and examine it through multiple historical lenses. The 2008 crash provides the most recent and clearest example. Let me give you the exact numbers. In 2000, the median home price in the United States was about $165,000. The median household income was about $42,000. That's a price-to-income ratio of about 3.9. Very healthy, very sustainable. By 2006, the median home price had climbed to about $220,000. The median household income had risen to about $48,000. The price-to-income ratio is now 4.6. That doesn't sound too bad. Only a modest increase. But these are national averages. They hide the extremes in bubble markets. In California, the median home price in 2006 was about $560,000. Median household income was about $60,000. That's a ratio of 9.3, nearly 10 times income. In Florida, particularly in markets like Miami and Naples, homes were selling for 8 to 9 times income. In Las Vegas and Phoenix, same story, 7 to 9 times income. These ratios were completely unsustainable. To understand why, you need to think about the math of home ownership. A household earning $60,000 per year has about $5,000 per month in gross income. After taxes, maybe $3,800. Lenders traditionally used a rule that your housing payment should not exceed 28% of gross income for this household. That's $1,400 per month. At a 6% mortgage rate with 20% down on a $560,000 home, the monthly payment would be about $2,700 for principal and interest, plus property taxes of maybe $500, plus insurance of maybe $200. Total housing payment of $3,400 per month. That's 68% of gross income, double the traditional limit. It was mathematically impossible for median income households to afford median price homes in these markets. So who was buying? People using exotic mortgages with teaser rates, interest-only loans where you don't pay down principal, adjustable rate mortgages with 2 or 3% teaser rates for the first few years, option ARMs where you could choose to pay less than the interest due. These products allowed people to afford the initial payments, but they were time bombs. When the teaser rates reset, the payments would jump by 50 to 100%. Most borrowers couldn't afford the reset. They were counting on refinancing before the reset. And refinancing was only possible if home prices kept rising so they'd have equity. The whole structure depended on continuous price appreciation. When prices stopped rising in 2006, the ability to refinance disappeared. When the teaser rates reset in 2007 and 2008, borrowers couldn't afford the new payments, defaults spiked, foreclosures exploded. This flooded the market with supply. Prices collapsed. In California, the median home price fell from $560,000 in 2006 to about $250,000 in 2009, a decline of 55%. In Las Vegas, prices fell 60%. In Phoenix, 50%. In Florida, similar declines. The price-to-income ratios normalized back to 3 to 4 times. But the damage was catastrophic. Millions of homeowners were underwater. Millions lost their homes to foreclosure. The financial system nearly collapsed because of all the bad mortgages. Now let me contrast this with a healthy housing market to show you what sustainable price growth looks like. From 1995 to 2000, before the bubble started, home prices rose at about 3 to 4% per year nationally. Incomes rose at about 3 to 4% per year. The price-to-income ratio stayed stable around 3.5 to 4. This was healthy. Prices were rising in line with fundamentals. People could afford homes. There was no speculation, no exotic mortgages, just normal housing demand driven by population growth, household formation, and income growth. When you see this kind of steady, moderate price growth that tracks fundamentals, that's sustainable. That can continue for years or decades. But when you see price growth of 10, 15, 20% per year while incomes are only growing 3%, that's unsustainable. It will end badly, always. Let me give you another historical example. Japan in the 1980s. This is actually an even more extreme case than the U.S. in 2006. Japanese real estate prices went completely insane. The Nikkei stock index went from about 7,000 in 1980 to nearly 39,000 in 1989, a 5-fold increase in less than a decade. Real estate prices rose even more. Land prices in Tokyo increased by a factor of 10 in some areas. By 1990, the total value of all land in Japan was estimated at about 4 times the total value of all land in the United States. Think about that. Japan is the size of California. The U.S. is 50 times larger. But Japanese land was supposedly worth 4 times as much. Absurd. Commercial real estate in Tokyo was trading at cap rates of 1% or less. That means if you bought an office building for $100 million, it would generate $1 million per year in net operating income. You'd need 100 years to get your money back. Why would anyone pay these prices? Pure speculation. The belief that prices would keep rising forever. Japanese culture has a particular reverence for land. There's a saying, land never depreciates. This cultural belief, combined with easy credit from Japanese banks, drove prices to levels that made no economic sense. The bubble popped in 1991 when the Bank of Japan raised interest rates to cool the economy. Real estate prices began falling, and they kept falling for over a decade. By 2003, land prices in Japan were back to 1983 levels. 20 years of gains wiped out. Commercial real estate in Tokyo fell by 70% from peak. The crash destroyed the Japanese banking system. Banks had lent trillions against real estate collateral. When real estate values fell, the collateral was worth less than the loans. Banks were sitting on massive losses. The government had to bail out the banks, but the damage was done. Japan entered what economists call the lost decades. 20 years of economic stagnation, deflation, and declining living standards. The real estate bubble and subsequent crash destroyed an entire generation's wealth and economic prospects. This is what happens when price appreciation completely disconnects from fundamentals. The correction is brutal and long-lasting. Now let me talk about warning sign 2, easy credit and declining lending standards, in much greater depth. I want you to understand just how reckless lending became before the 2008 crash. In a normal mortgage market, lenders verify that borrowers have the income and assets to repay the loan. They check employment. They verify income with pay stubs and tax returns. They check bank statements to verify down payment funds. They verify that the borrower's debt-to-income ratio is reasonable, typically below 43%. This underwriting process protects both the lender and the borrower. The lender is reasonably confident they'll be repaid. The borrower is not taking on debt they can't afford. But in the early 2000s, this underwriting process broke down completely. Why? Because of mortgage securitization. Lenders were no longer holding the loans they originated. They were selling them to investment banks. The investment banks would package thousands of mortgages into mortgage-backed securities and sell them to investors. Pension funds, insurance companies, foreign governments. These investors were buying the securities based on credit ratings from rating agencies like Moody's and S&P. The rating agencies were giving AAA ratings to securities backed by subprime mortgages. Everyone in the chain was getting paid and passing the risk to the next guy. The lender got a fee for originating the mortgage. They didn't care if it defaulted because they'd already sold it. The investment bank got a fee for packaging and selling the securities. They didn't care if the underlying mortgages defaulted because they'd already sold the securities. The rating agencies got paid by the investment banks to rate the securities. They had an incentive to give high ratings so the deals would get done and they'd get more business. The investors buying the securities were relying on the ratings. They assumed AAA meant safe. They didn't do their own due diligence on the underlying mortgages. This structure created catastrophic incentives. Lenders had every incentive to make as many loans as possible, regardless of quality. More loans meant more fees, and they had no incentive to care about loan quality because they weren't holding the risk. So they started making loans they never would have made if they were holding them. Stated income loans, where the borrower just stated their income without verification. These were called liar loans for obvious reasons. People would claim they earned twice or 3 times their actual income to qualify for bigger loans. Lenders didn't care because they'd sell the loans anyway. No documentation loans, where the borrower didn't have to provide any documentation of income or assets. Just fill out an application and you'd get approved. Ninja loans. No income, no job, no assets. You literally could be unemployed with no savings and get approved for a mortgage. No money down loans, 0 down payment. You could buy a house without putting in a single dollar of your own money. This meant you had 0 equity from day one. If prices fell even 1%, you were underwater. Piggyback loans, where you'd take out a second mortgage to cover the down payment, so you'd get an 80% first mortgage and a 20% second mortgage. Total loan of 100% of the purchase price. Again, 0 equity. Interest-only mortgages, where you only paid interest for the first 5 or 10 years. You weren't building any equity through principal paydown. You were entirely dependent on price appreciation to build equity. Option ARMs, where you could choose your payment each month. You could pay the fully amortizing amount, or you could pay interest only, or you could pay less than the interest, and the shortfall would be added to your principal balance. People naturally chose the lowest payment option. So their mortgage balance was actually growing over time. They were going backwards. Negative amortization. When I first heard about these products, I couldn't believe they were legal. They were designed to fail. They allowed people to buy homes they had no ability to afford. And they made everyone in the mortgage origination chain rich while transferring all the risk to the eventual owners of the mortgage-backed securities. Let me give you a specific example. A borrower with no job and no savings could claim on a stated income loan that they earned $10,000 per month without verification. They could buy a $400,000 house with zero down using a piggyback loan structure. Their first mortgage would be an option ARM for $320,000 at a 1% teaser rate. Their initial payment would be about $1,000 per month. Their second mortgage would be $80,000 at 8%, payment of about $600 per month. Total initial payment of $1,600 per month. This seemed affordable based on their stated income of $10,000 per month. The lender would approve the loan, immediately sell it to an investment bank, and collect a fee. The investment bank would package this loan with thousands of others, get it rated AAA by a rating agency that knew nothing about the underlying loans, and sell it to a pension fund. The borrower would make the minimum payments for a while, but after a year, the option arm would reset, the teaser rate would go to 7%. The minimum payment would jump to about $2,500 just on the first mortgage, plus the $600 on the second mortgage, total payment of $3,100 per month. The borrower, who actually had no job and no income, couldn't make this payment. They'd default. The loan would go into foreclosure. The house would be sold at a loss. The pension fund that owned the mortgage-backed security would take a loss. Multiply this scenario by millions of loans, and you understand why the financial system nearly collapsed in 2008. The entire mortgage market was built on fraudulent loans that were designed to default. And no one cared because everyone was getting rich on fees. When I studied the mortgage market in 2005 and 2006, I couldn't believe what I was seeing. I knew it would end catastrophically. The only question was when. I positioned my fund to profit from the crash by shorting mortgage-backed securities and companies with heavy subprime exposure. Other investors like Michael Burry and John Paulson did the same. We made billions when the crash came, but we were a tiny minority. Most of Wall Street was long the mortgage market. They believed housing prices would keep rising. They ignored the fraud and the terrible underwriting. They paid the price when the crash came. Now, let me contrast this with proper lending standards to show you what responsible mortgage lending looks like. In a properly functioning mortgage market, the lender verifies income with pay stubs and tax returns for the past 2 years. They verify employment by calling the employer or checking recent pay stubs. They verify assets by reviewing bank statements for the past 2 to 3 months. They verify that the down payment funds are the borrower's own money, not borrowed. They calculate the borrower's debt-to-income ratio, including the proposed mortgage payment plus all other debt payments, divided by gross monthly income. This should be below 43%. They verify that the borrower has reserves, typically 2 to 6 months of mortgage payments, in savings to cover unexpected expenses. They order an appraisal to verify that the home is worth the purchase price. They review the borrower's credit report to check for late payments, bankruptcies, foreclosures. This underwriting process takes time and effort, but it protects everyone. The lender is confident the borrower can repay. The borrower is not taking on more debt than they can handle. The mortgage is a good investment if it's securitized and sold. This is how mortgage lending should work, and this is largely how it works today. After the 2008 crash, regulations were tightened. The Dodd-Frank Act imposed stricter standards. Lenders have to verify income. They have to ensure the borrower has the ability to repay. No more stated income loans. No more ninja loans. The improvements have made the mortgage market much safer. Lending today is far more conservative than it was in 2006. This is why I don't expect a crash as severe as 2008. The bad loans simply aren't being made at the same scale. But there are still risks. Low interest rates from 2020 to 2022 allowed people to borrow large amounts. Now that rates have risen, affordability has collapsed. Some recent buyers may struggle, but it won't be a systemic crisis like 2008. Now let me go deeper into warning sign 3, rampant speculation and investor activity. Speculation fundamentally changes the dynamics of a housing market. When owner-occupants dominate, the market is driven by real housing needs. People buy homes to live in. They consider affordability, school quality, commute times, neighborhood amenities. They're making long-term decisions. They'll stay in the home for years, often decades. They're not looking to flip for a quick profit. They're not obsessively watching prices. They're building a life. This creates stability. Owner-occupants don't panic sell if prices dip. They're not trying to time the market. They're just living in their homes. But when speculators dominate, everything changes. Speculators are buying purely for financial gain. They have no intention of living in the properties. They're looking to flip for a profit or rent for income. They're momentum buyers. They buy because prices are rising. They have no emotional attachment to the properties. If prices stop rising or start falling, they'll sell immediately. This creates instability. Let me give you numbers from the 2008 bubble. In 2005, at the height of the bubble, investor purchases were about 28% of all home sales nationally. That's more than 1 in 4 buyers. In bubble markets, it was much higher. In Phoenix, investor purchases were about 40% of sales. In Las Vegas, 38%. In Miami, 35%. These speculators were buying multiple properties with no money down, planning to flip them before the first mortgage payment was due. There were people buying 10, 20, 50 properties. They weren't landlords building a rental portfolio. They were flippers trying to make a quick buck. TV shows like Flip This House and Property Ladder glorified this behavior. Real estate seminars promised easy riches. Infomercials sold courses on how to flip houses with no money down. The psychology was pure greed and FOMO. People saw their neighbors making money flipping houses. They didn't want to miss out. They jumped in without understanding the risks. When prices peaked in 2006 and started falling in 2007, all these speculators panicked. They had bought at the top with maximum leverage. They were immediately underwater. Many had negative cash flow if they were renting the properties out. Rents hadn't risen as much as prices. The properties were losing money every month. The speculators tried to sell, but everyone was trying to sell at the same time. There were no buyers. Inventory exploded. In Phoenix, months of supply went from 3 months in 2005 to 15 months in 2008. In Las Vegas, similar story. All this inventory put massive downward pressure on prices. The speculators who couldn't sell just walked away. Strategic default. They mailed the keys to the bank and let the property go into foreclosure. Why not? They had no money in the deal. They had no emotional attachment. Walking away was the rational economic decision. This wave of strategic defaults added even more foreclosed properties to the market, more supply, lower prices. It became a death spiral. Now contrast this with a market dominated by owner-occupants. In a healthy market, investors might be 10 to 15% of buyers. The rest are people buying homes to live in. When prices dip, owner-occupants don't sell. They're not trying to flip. They're living in the house. They'll ride out the downturn. This prevents the panic selling that crashes prices. Inventory stays low. Prices stay relatively stable. The current market had a spike in investor activity during the pandemic. In 2021, investors were about 30% of buyers in some markets. They were buying single-family homes to rent out. Institutional investors like Invitation Homes and American Homes for Rent were buying thousands of properties. Individual investors were buying too. But this was different from 2006. These investors were planning to rent, not flip. They were building rental portfolios for long-term cash flow. They weren't as dependent on price appreciation. And the investor share has declined in 2023 and 2024 as prices have leveled off. Investors are more cautious. They're not buying as aggressively. This reduces the risk of a crash driven by speculator selling. Still, the investor buying in 2021 pushed prices higher than they should have been. When those investors eventually sell, it will add to supply and pressure prices. But it won't be the same panic selling as 2006 because most are holding for rental income, not flipping. Now let me discuss warning sign 4, overbuilding and excess supply, with much more detail. The construction cycle is crucial to understanding housing markets. Building a home takes time. From the moment a developer decides to build to the moment the home is ready for sale is typically 18 to 36 months. They have to acquire land, get zoning approvals, get building permits, do site preparation, build infrastructure, construct the homes. All of this takes time and capital. During a boom, developers see strong demand and rising prices. They decide to build, they start projects. But by the time those projects are completed and homes are ready for sale, market conditions have changed, demand has weakened, prices have peaked, and suddenly all this new supply is hitting the market at exactly the wrong time. Let me show you this with data from the 2008 cycle. In 2003 and 2004, housing starts were running at about 1.5 million units per year nationally. This was roughly in line with underlying demand from population growth and household formation. Builders were building at a sustainable pace, but in 2005 and 2006, starts surged to over 2 million units per year. Builders were racing to meet demand, or rather, they were racing to meet apparent demand. Much of that demand was from speculators, not real housing need. Builders didn't care. They saw buyers, they built, Those 2 million units started in 2005 and 2006 would be completed in 2006, 2007, and 2008. But by 2007, the market had turned, prices were falling, speculators were gone, credit was tightening, real housing demand had collapsed, and all those homes started during the boom were now completing. New supply flooded the market right as demand disappeared. Builders were desperate to sell. They slashed prices, offered incentives, free upgrades, paid closing costs, anything to move inventory. But it wasn't enough. Inventory of new homes for sale reached record highs, over 700,000 new homes for sale at one point. At the sales pace in 2008, it would have taken over 2 years to sell all the inventory. 2 years of supply. Builders stopped starting new projects. Housing starts collapsed to under 500,000 units by 2009, the lowest level since World War II. Thousands of construction workers were laid off. Suppliers went bankrupt. The housing construction industry was devastated. And all those completed homes that couldn't be sold put downward pressure on all home prices, not just new homes, existing homes too. If a new home was selling for $200,000, why would anyone pay $250,000 for an existing home in the same neighborhood? Builders were undercutting the entire market. This is the danger of overbuilding. The lag between starting construction and completing means supply surges, right, as demand weakens. And the excess supply crushes prices. Now contrast this with the current market. From 2008 to 2020, housing construction was depressed. Builders were scarred by the crash. They built cautiously. Starts averaged only about 1 million units per year, well below the 1.5 million needed to keep up with household formation. This created a cumulative shortage. We underbuilt by about 500,000 units per year for 12 years. That's about 6 million missing homes. This shortage is why inventory of existing homes for sale is so low today. There simply aren't enough homes. Months of supply is around 3 months nationally, well below the 6 months. That indicates a balanced market. Builders have ramped up construction somewhat. Starts are now around 1.4 million units per year. But even at this pace, we're not overbuilding. We're just getting back to the level needed to meet demand. This lack of excess supply is a crucial difference from 2008. Without a glut of inventory, it's hard for prices to crash. Even if demand weakens, sellers don't have to panic. They can wait for a buyer. They don't have to slash prices. This is why I expect a correction, not a collapse. Demand is weak because of high rates, but supply is tight. The two forces roughly balance. Prices will drift lower, but not crash. Now let me talk about warning sign 5. Euphoria and belief that prices only go up in much more psychological depth. Market euphoria is one of the most reliable indicators of a top. When everyone is bullish, when skepticism is non-existent, when it seems crazy not to buy, that's when you're at the peak. The psychology of bubbles is well studied. It follows a predictable pattern. It starts with a legitimate catalyst. In the early 2000s, it was low interest rates and strong economic growth. Home prices started rising for good reasons. Early investors who bought saw their homes appreciate. They made money. They told friends and family. This attracted more buyers. Prices rose more. Media coverage became positive. Articles about the hot housing market. Stories of people making fortunes, flipping houses. This attracted even more buyers. Momentum builds. As more people buy and prices keep rising, skepticism fades. People who initially thought prices were too high see they were wrong. Prices kept rising, they missed out, they don't want to miss out again. FOMO, fear of missing out, becomes the dominant emotion. People who were cautious become aggressive. They jump in. At this stage, the narrative changes. It's no longer just about prices rising. It's about why this time is different, why the old rules don't apply. In the 2006 bubble, the mantras were, they're not making any more land, everyone needs a place to live, real estate always goes up. We're in a new era of permanently low interest rates and globalization. These narratives justified ever higher prices. People convinced themselves that normal valuation metrics didn't matter. Price to income ratio of 9 times doesn't matter because we're in a new paradigm. These rationalizations allowed the bubble to inflate further. Skeptics were dismissed as fools who didn't understand the new reality. If you suggested prices were too high, people would mock you. You've been saying that for 3 years and prices have doubled. When are you going to admit you're wrong? This social pressure silenced skeptics. No one wanted to look foolish. Everyone jumped on the bandwagon. At the peak, the euphoria is universal. Real estate agents are making huge commissions. Mortgage brokers are getting rich. Builders are flush with cash. Homeowners feel wealthy as their home values soar. Everyone has a story about how much money they made. Your hairstylist bought 3 condos. Your dentist is flipping houses. Your neighbor refinanced and bought a boat. It seems like everyone is getting rich except you. The pressure to participate becomes overwhelming. At this point, professional investors have often already sold. They recognized the bubble earlier and took profits. But retail investors, regular people, are piling in at the top. They're the last buyers, the bag holders. When the euphoria reaches this peak, there are no new buyers left. Everyone who's going to buy has bought. Demand can't increase further. But supply is still increasing because of all the building started during the boom. When demand stops growing but supply keeps increasing, prices stop rising. Once prices stop rising, the psychology reverses instantly. If prices aren't going up, why own real estate? The only reason to buy was for price appreciation. If that's gone, the investment thesis is gone. Speculators sell. This pushes prices down. Decline begins. As prices fall, fear replaces greed. People who felt rich now feel poor. They're underwater on their mortgages. They're watching their net worth evaporate. They panic. They try to sell, but everyone is trying to sell. There are no buyers. Prices fall further. The media coverage turns negative. Stories about the housing crash, foreclosures, people losing their homes. This scares potential buyers away. They decide to wait. Demand collapses. The crash feeds on itself. This is the psychology of bubbles. Euphoria at the top, panic at the bottom. Greed and fear drive prices far from fundamental value in both directions. The rational investor recognizes this pattern. They sell when euphoria is peaking. They buy when panic is peaking. They're contrarian. But it's incredibly hard to be contrarian. It requires ignoring social pressure, trusting your own analysis, and accepting that you'll look foolish in the short term. In 2006, I was telling people the housing market was going to crash. Most people thought I was crazy. They were making money. Their homes were appreciating. Why would they listen to some pessimistic hedge fund manager? But I had done the analysis. I knew the fundamentals didn't support prices. I knew the lending was fraudulent. I knew it would end badly. I positioned my fund to profit from the crash, and I was right. But being right early meant looking wrong for a while. That's the challenge of being contrarian. You have to have conviction and patience. So those are the 5 warning signs in great detail. Excessive price appreciation disconnected from fundamentals, easy credit and declining lending standards, rampant speculation and investor activity, overbuilding and excess supply, euphoria and belief that prices only go up. When you see all 5, a crash is certain. When you see 3 or 4, a correction is likely. When you see 1 or 2, be cautious, but it might be manageable. Right now, we're in the 3 out of 5 category. Prices rose too far. Credit was too easy through low rates. Speculation was rampant in 2021, but lending standards are decent and supply is tight. This suggests a correction, not a collapse. Prices will fall 10 to 20%, maybe more in bubble markets, but it won't be 2008 again. Still, if you're buying or selling or investing in real estate, you need to understand these dynamics. You need to know where we are in the cycle. You need to make decisions accordingly. That's what this analysis is for, to give you the tools to navigate the housing market successfully.